Joining us now is Mark Zandi, Chief Economist for Moody's Analytics. Good morning to you, Mark.
Good morning.
So the question on everyone's mind now is, are we heading into that double-dip recession?
No, I don't think so. I think the economy has its troubles, no doubt. The stock market's decline is certainly very disconcerting to watch. But we're in a much better place today than we were a year ago, 2 years ago, 3 years ago. We've made a lot of progress, and I think ultimately that will shine through.
On Main Street, though, it doesn't necessarily feel like we've made that progress, and that has really weighed on confidence. So even if we're not technically in the recession, does it matter if people in the real world feel like we are?
Yeah, absolutely. Confidence is key, and that's why we have to maintain our confidence in this current environment. We can't panic, because if we panic, then we pull back. Consumers stop spending, businesses stop investing and hiring, and that's a prescription for recession. I don't think there's any reason for that panic. I think we should remain calm, and if we do, I think those better fundamentals will ultimately come through and the economy will improve.
Stock market still dropped more than 630 points yesterday. That's the kind of thing that instills panic. How do politicians, how does corporate America, how does Main Street get away from that sense of, wow, this is a really scary thing that's happening right in front of me?
Yeah, it is scary, but it's important to remember that the stock market goes up, down, all around. The stock market has predicted 9 of the last 5 recessions, an old adage in the economics profession. So it is something to watch. It is very nerve-wracking to watch. But at the end of the day, the stock market will turn around given the better economic fundamentals.
The ball is now squarely in the Federal Reserve's court. Is there anything the Fed can do now to change both the dynamic on Wall Street as well as how we feel on Main Street?
Yes, and this is very important to turning confidence around and righting the stock market. They can ease monetary policy. They can lower interest rates again. They can make it very clear that they're not going to raise interest rates for a long period of time, and that would also be helpful. And of course, if push comes to shove, they can do another round of what's known as quantitative easing, going out and buying long-term Treasury bonds. So there's more room for them to maneuver, and I think they'll take that room and do something with that today.
Mark Zandi, thank you. We appreciate it.
Thank you.